All right. So thanks, Tom. Okay, now
All right.
today we're going to be covering the top ways that you can get fooled by performance data, and part of the reason for that is because over the past while I've been getting more into the algorithmic side, and as part of that, also intro to the traditional portfolio stuff, which I've been doing for quite a while. But it was challenging in a way because even though some of the theory has been around for a long time, so things like modern portfolio theory has been around since what 1950s. The problem has been that it's kind of tricky to understand, but the bigger issue is that there are no tools available to put those modern portfolio theory concepts into practice, and therefore the result was that you had to learn something like Python or R or some other kind of advanced language, and that was of course a huge stumbling block. So a while back I kind of came across a site that just blew me away with just how good it was with all the functionality it provides, and it actually can tap in through to a lot of the modern portfolio theory concepts, and it's completely free. So I'll be kind of quickly showing that site towards the end of the presentation. But before I get there, obviously when you're using any kind of tool and looking at any kind of portfolio, you see these beautiful risk graphs. Not sorry, risk graphs. My head's still in option trading. You see all these beautiful equity graphs, and you can very easily be tricked. Because I've got a lot of my members that have gone out and they're looking for signal providers and so on, and they're asking for my opinion. If I think they're any good, and you do a bit of digging, and you quickly find out that they're at best not understanding the information they're presenting, and at worst they're literally just trying to screw people by tricking them. So I put together a presentation that goes through a lot of the ways that providers can try and trick you. But if you don't want to look at it from a nefarious kind of perspective, it's just useful stuff to know, because you can fall for these traps yourself without knowing it. Okay, so that's basically what we're going to go through. So here is a sample signal provider. The specific provider doesn't really matter, but it's just, I think, a fairly decent example. This was actually one of the sites that some of my members were asking me to give my opinion on. And you hit their homepage and you see this kind of stuff, right? And I've purposely hidden the names so that, I'm not just trying to bag them. I'm just trying to use them as an example here so you can see the teaching point. And the primary thing is that when you look at this, you see the compound annual growth rate, and the numbers look fantastic. Okay, you then look at the max drawdown over here, and they seem really good too, right? Like a 10-11% drawdown when you're getting compound annual growth rates of 20 plus. That is fantastic. It really is good, and it's no wonder they actually have that on their homepage. But the first thing is that you have to start looking at this number here. And what this thing is basically telling you is that this is the compound annual growth rate over the last 5 years. And that is hugely important. Now, why is that? Well, the reason is because we have been in the most bullish decade in terms of the stock market performance, pretty much almost in history. And you can just visually see this over here is the last 10 years. You can see just how crazy we've gone higher. And when you're looking at the last 5 years, you're looking at just this leg here. Look at the steepness of that curve. Okay, it doesn't take much. You can almost throw a dart at anything and get performance that is pretty darn good if the entire market is performing like this. So it's no surprise they're getting stats that are just fantastic. Now, if you then dive in through to, if you actually become a member of this particular site, then they expand the look back period from 5 years to 10 years. Okay, with all of the actual strategies, and they give you full, monthly breakdowns and all that kind of stuff. But here's the thing. Based on the current date that we're at now, right, and we're currently at 2019, what is this, July 25 today, right? So we're halfway through 2019. Now what happens is that even going back a full 10 years over here, what happens is that this is not included in the sample set. So even though a signal provider is giving you what appears to be a pretty decent look-back period, that look-back period is a single market condition, and that single market condition is the most bullish decade we've had in history. So if you're looking at something like this and you're looking for a system that you're essentially going to be trading over the long term, it is extremely misleading to just look at a single market condition. Ask any backtester that does algorithmic programming, and they're always going to tell you you want to make sure that you try and include all market conditions within your actual sample backtest. And this is just one. This basically is just super bullish, and that's it. And again, doesn't even include this drop over here. So what can happen is that you can fall for a trap now where you go in through to a particular algo or signal provider or whatever that might be, and you look at the stats, and the stats are now going to tell you one thing, but now what happens is that when we do get the next kind of pullback over here, then you're now going to get results that are nowhere near what you actually expected, and you'll probably lose sleep and all that kind of stuff, not to mention probably seeing half of your capital go away, right? And just by looking at this, I'm not trying to do crystal ball kind of stuff here or anything like that, but if you just look at the rough time period, right, the major crashes we've had basically is, this doesn't look like anything, and I'll cover this in a second, but this is essentially the 87 crash. Then we had the 2000 stock market bubble kind of crash, or the dot-com crash. Okay, and so you can see that there's roughly a 10-year period here. And then we had the 2008-2009 financial crisis, roughly 10-year period over here. And what have we had here? We've now gone for another 10 years. So simply by looking back, and sure, you might say, well, this is only a sample set of 2 or 3 items, that's not significant. But going back on that, based on that, it would not be surprising at all to see some kind of decent-sized correction coming sometime soon. So if you're getting in through to some kind of portfolio, and here what I've done is I've just simply used portfolio 1 just being the standard stock market and nothing else, all right? It's just the standard US stock market, nothing else. So think of it just as SPY, all right, if you're trading an ETF. So if you're trading that, but just using that as a sample algo, and you're looking at the stats and you say, hey, compound annual growth rate, 14.24, that seems pretty nice. Max drawdown, 17.84. You might say, that's okay. I can live with up to, let's say, a 20% drawdown. And you say, yep, and you put all your money in through to that portfolio and, go forward. But next thing you know, when you extend the actual backtest period to include multiple market conditions, that 17% now goes through to 51. That is day and night, okay? And this is basically part of what you are facing with a signal provider, that their backtest sample period is going back 10 years and no more. Because now, again, that 10 years does not even include this. 10 years is not enough. You have to go back further in order to include crashes, in order to get a reasonable expectation of what this max drawdown is going to be, in order to get a reasonable expectation of what the volatility of your portfolio is going to be. Okay? I know everybody always focuses on compounding your growth rate, but this is only partially useful, right? What matters is a lot of the other stats, and especially what tends to matter a lot. Well, obviously max drawdown is related to that. Sure, standard deviation is important, but you have ratios like this that try to take risk-adjusted returns into consideration and give you a number that measures the combination, essentially, of the growth with the actual risk that's in the portfolio. And so Sortino is similar as well. Sortino looks at downside deviation instead of just standard deviation. So basically the point is that you really ideally want to, if you are going to go with some kind of portfolio or some signal provider or whatever that might be, you really want to take a look at the drawdown chart. Because what's going to happen with that particular drawdown chart is you can very, very easily visually look at a drawdown chart and say, well, okay, I can easily see that's a 45% drawdown. This thing over here is almost a 50% drawdown. I've got another drawdown over here of 30%, and so on and so on and so on. Okay, very easy to visually see what those drawdowns are, as opposed through to a graph, even something like this, where you do see some dips, but you just have no idea of what it actually feels like. How much of a drawdown actually is it? Whereas if you look at a drawdown chart and you say, oh, geez, I definitely couldn't take a 50% drawdown, so maybe this portfolio is not for me. Okay? And by the way, this is the portfolio of just the market. And this is another thing that you may kind of want to take into consideration, because a lot of the time, if you've got money in your 401k or whatever that might be, the so-called managers will, machine gun allocations across all these different asset classes. But what you'll find is that they're typically very heavily weighted in through to large cap. And this is large cap. This is basically SPY performance. And you will find pretty massive drawdowns when you get major market crashes. And if that's not something you want, then that's something you have to at least start with an awareness of. Okay. All right. So that was a pretty important concept in terms of understanding that the last 10 years has been massively bullish, and therefore you need a much larger sample. This one over here is now getting into the little tricks that that providers tend to do. And one of them is that the great majority of them, if not, well, I'll just say the great majority of them, what they'll do is that they will basically be tracking monthly prices. And due to tracking monthly prices, what's happening is that you don't see any of the intra-month performance. So what can happen, and I've hidden the timeline because it's not a perfectly valid example, but it gives you the sense of what I'm trying to get at. Because if this over here is the first of the month, and then you get this big drop, in this case over here you got a V-shaped bottom, so you're not going to, you don't have to be in too much pain for too long. But let's say that at the start of the next month you're back here again. You might, when you then look at the performance graph that they're actually showing you, in terms of your equity, the equity here and the equity here is exactly the same. So you see no drawdown. Whereas in reality, you may have gone through a massive drawdown over here, much, much larger than what you'd be expecting. And when you're watching this and it's a live portfolio, and you may be checking your actual equity on a daily basis, which is not a good idea, by the way, but let's say that that's the case, then you just have no idea, because you came into this thinking that there would be no drawdown, and suddenly, just because they're using monthly prices, that can hide all of the intra-month movements, including hiding the ugly stuff. And by the way, sorry, I'm just bringing up the chat window so I can keep my eye on any questions that come up too. So, all right.
None so far.
Yep, we're good. So, okay, back over here. Next little trick is what they call, you might think that the term drawdown is standardized. Everybody understands what drawdown means. Well, not quite. You'll find that there are some providers out there that they distinguish between what's called equity drawdown versus what they call peak drawdown. And in a nutshell, your peak drawdown is what all of you are likely thinking of. So everybody kind of thinks, okay, if my equity is doing this, and then suddenly I get this, then from the highest peak down through to the lowest point of the valley, that there is your drawdown. And everyone says, okay, that obviously is the way that everyone defines it. Okay, that is peak drawdown. But what some signal providers out there do is they basically focus on equity drawdown. And what equity drawdown means is that this is just for closed trades. So if they opened a trade here, then the market did this, and then the market does this, and then for that particular trade, if they then closed the trade over there, they show that as a profit with no drawdown. Okay, because all they're tracking is the equity when the trade was opened and the equity when the trade was closed. That's it. That's what I call equity drawdown. That is totally different from peak drawdown because it hides all of this stuff over here. And what I found interesting is actually there's some algorithmic backtesting software. Believe it or not, the default in some of the software is an equity drawdown, which blew my mind, right? When you see that, you go, what the hell? So, but just be aware of that, okay? So equity drawdown versus peak drawdown, very different. The stuff that you've got in your head is a peak drawdown, but if you're looking through the fine print of some kind of signal provider and they basically say that they track equity drawdowns, now you know what that means. Okay, now, this is another very common thing, which is that when people see performance graphs, their eyes go to the bottom left, and if they see that on the right-hand side it's higher, and to the right, their brains just go, yep, that looks pretty nice, and that looks like a pretty nice profit, and I'm happy. But what happens is that, especially when you go further back in time, here I didn't quite point the arrow to the right place. It's actually this little blip there. But if you look at that little blip and you say that's absolutely tiny, I wouldn't have had any pain there. Okay, you might say, well, all right, I may have taken some pain here, I may have taken some pain here, but you say that's nothing. Okay, well, that there is actually a 30% drawdown, believe it or not. That's the 87 crash. Okay, we came down 20-something% in one day. And people were literally killing themselves right on that day. That's how bad the market was. So, when you switch from a linear scale kind of diagram, which is what you just saw, through to a log scale diagram, that can now give you a different representation due to the fact that the axis is scaled differently. But you can visually now see things a little bit more clearly. You can see that there was a drawdown here. You see this, you see this, you see this, okay? You see it there and so on. Whereas when you go back, it just looks like a flat line. You don't see much at all, right? So be aware of that, because when you are looking at a performance graph, you might say, hey, I've taken note of what that Ron dude told me about in that presentation, and I've not just looked at the last 10 years. I've gone all the way back to 1972. But now you're finding yourself in another trap, which is that when you go back this far, due to the fact that the stock market has increased so much in price, that when you then look at the performance graph, you are tricked into thinking that this is a nice, slow and steady, no pain whatsoever kind of movement. Okay? So one of the steps that you can take there is to, when you have this kind of stuff, if you want to get a decent understanding of what performance looked like a long time ago, you definitely need to switch over through to log scale, and then you're going to get a graph like this. But remember that the key thing that you want to do, I think I've got that on the next slide, yeah. So the key thing is that, well, if we recap, this is linear scale, very, very tough to see anything whatsoever going back in history. This is log scale, much easier to kind of visually see it, but by far, the best thing is looking at a drawdown graph. Okay? It doesn't take a rocket science degree to basically say, how deep is this thing here? It's 30%. What's this? 45%. And so on and so on. Okay? So, drawdown graphs should become your new friend if you want to get a easy visual representation of what the risk is in that particular portfolio, as opposed to risk graphs, sorry, I keep saying risk graphs, as opposed to equity graphs that can very easily hide information. And most of the time with signal providers, they don't provide this. Most of the time, they'll just show a linear scale type of graph that goes from bottom left to top right, and that's it. No log scale, no drawdown graph. No surprises why. All right, so this is just saying a drawdown graph is a best friend. Try to have one there. And there are ways, of course, that you can grab, if they do provide, let's say, the monthly results, the monthly performance results in like a calendar view or something like that, which is sometimes available. You can translate that in through to something like this, so that you actually can get to see all of the performance data. Okay, I'll kind of touch on that a little bit later on too. Okay, so very, very quick pop quiz with the people that we've got on. Just making sure that we level set. So if I have a portfolio, my portfolio basically goes up by 50%, comes down by 50%. We're essentially back through to where we started, right? Everyone agree with this? Yes, no?
No.
Definitely not.
All right, so let's just quickly do an example here. So we start off with $100. Then our portfolio, which consists of $100, increases by 50%. So now it is at $150. And now our portfolio that is at $150 decreases by 50%. We are now at 75. From here to here, you are at a 25% net loss. Okay? Now, why am I saying this? Well, one of the reasons is that if you see a signal provider, and the signal provider is, they're showing, Jan, Feb, March, blah, blah, all the way out through to December, and then they say yearly, and you see that typical table that you see, right? Believe it or not, I have seen some signal providers that you'll see something here that it says, 3%, 2%, -1, blah, 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 blah. You then look at the yearly result. The yearly result is the arithmetic average of all of these results. So in other words, they're doing this. They're basically saying it goes up 50% one month, goes down 50% the other month. On the yearly result, that would have said 0. All right, this is insane. I could not believe it when I saw this kind of stuff, right? And the reason is that what they're doing is that taking just the simple average across these results, they're not taking any compounding into account, right? This is essentially the difference between an arithmetic average versus the compounded average. And that can just be absolutely massive. So be careful with that, right? And this chart here is hopefully going to help you understand the impact of that, because what happens is that if you do draw down by 50%, then in order to get back to break even, you do not have to make 50% up, you have to make 100% back, just like we saw before. Okay, so the impact of this is that your drawdowns, you saw before that I basically said that max drawdown graph was really, really important. It's not just so that you can properly interpret the little blips in the equity line. It's so that you basically understand this kind of concept, because this here implies that the deeper that you do draw down, the much, much harder it gets in order for you to get just back to break even, not even to make a profit, right? So it's really important to control your drawdowns, and it's really important to control your volatility of your portfolio. Right? And the reason for that is because volatility is always going to hurt your compounded returns, no matter what. So if you're looking at a portfolio, this is why a lot of people basically keep a very, very close eye on the standard deviation, which is essentially the volatility of that portfolio. This is the reason why a lot of people look at risk-adjusted returns, things like Sharpe ratios and Sortinos, Calmars, UPIs. There's a whole bunch of interesting performance stats that you can look at that try to take this into consideration, not just looking at your compounded return, because it's mathematically proven that volatility always is going to hurt your compounded returns, no matter what. So if you can minimize your volatility, and of course, if you can maximize your return, that is a way to get a portfolio that's going to be well performing. All right. Next thing is just to kind of be aware of when you're looking at a risk graph, an equity line that goes from bottom left to top right. A lot of the time, your emotions are not going to be involved in any way, and you just say, yeah, bottom left, top right looks good, I'm happy. But one of the things you have to do is you have to try and internalize the performance such that you try to feel what emotions you would have been going through, because sometimes that may prevent you from getting into a portfolio. And this is just essentially, you can see it's just the standard stock market, SPX. But when you were here and you then had a drawdown and the market actually recovered here, that's a 7-year period, right? And what happens once you get back through to being happy again, going, oh gosh, I waited 7 years, I'm finally back to break even. Boom, right? So you're now looking at a scenario that if you entered the market here, you spent 13 years in that investment before you got back through to break even, right? And while looking at something like this, you might say, yeah, bottom left to top right looks good to me. Could you have sat through 13 years of drawdown, is the question. And if that's not the case, then this is not the portfolio for you. All right, got a question here. Andrew saying performance with option trades is typically posted as P&L on planned capital, not total portfolio, making monthly average valid. Total portfolio. You're talking about option trading there, Andrew. So I'm not sure what you're referring to. Where in this example here, we're basically talking about just purely investing in traditional stock portfolios or ETFs.
Yeah, I think he's just saying if you keep the trade size the same, then like plus 50%, minus 50% would be valid.
Oh, I see what you're saying. Well, yeah, no, I'm talking about the concept of just your portfolio is your total investment in that portfolio, right? And you're tracking that on a portfolio basis. Okay, so in that instance, then the compounding, the volatility is always going to give you negative returns there. right? And I'll get down through to how to kind of combine option trading with portfolios in a little bit towards the end too. All right, so if you are in a situation like this and you're here, and then you've gone through all of this, drawdown period, recovery, drawdown period, recovery, but essentially from here to here, you've had nothing. You might look at this and say, well, even if I invested in some kind of portfolio, then the reality is that if the market did this, then in all likelihood, the other portfolios probably did just as bad or worse. Okay, but it's actually not the case. And this thing here is just showing you, so the red line is, think of this as SPX. This is essentially just the standard stock market, right? You can see it's the Vanguard 500 Index Investor, which is more or less basically SPY or SPX. And going from 2000, so what I'm doing here is I'm basically setting this to be the start date and this to be the end date. So as you can expect from this, it should essentially be a portfolio that is going to be flat. And that's what you get with the red line. Okay, so you can see here that the compound annual growth rate is very, very low. Not surprising based on the actual period that we chose. But even during this particular period, if we were to choose a portfolio over here that is invested in a few different things that hopefully are uncorrelated, then that portfolio during the same period where the market absolutely did nothing can still perform at a decent level. Okay, on top of that, this particular portfolio here, if you look at the market, right, you recall that in 2000, 2009, this was a 45% crash. This this is 50% here. This one here was 45, okay? And so you can see here, this particular max drawdown essentially relates through to that. But then if you compare that through to the blue line, you can see that the blue line, even during the same period, only drew down, let's call it 15%, which is far, far more reasonable than what you got with the market. Okay, so while the market went nowhere for 13 years, you can still have a portfolio that basically gave you decent performance. And on top of that, during periods where the market essentially was drawn down by almost 50% twice during that particular period, you've had other portfolios that can perform. And this is a simple portfolio, by the way, and one that I'll be showing you, by the way, by the end of the presentation. This only drew down by 15%. Okay, and you can see that also represented in some of the risk-adjusted returns over here. So you can see, what a big difference that is. All right, so we've briefly touched on linear scale versus log scale, and this is just kind of seeing them side by side. So the focus here is looking at all of this kind of data, and you just see overlapped lines. You just see nothing. Okay. Whereas if you flip over through to log scale, you can much more clearly see where you get outperformance and underperformance of two things that you're actually trying to compare. So very, very useful to be able to flip between the two. And something that's not typically provided a lot of the time by people providing signals. All right. It's in their interest to kind of hide the information back here, right? So you don't see it. This is just a note on entry timing, because what happens is that even though you might have an equity line that you're happy with, you just have to realize that it's not like you're wrapping some advanced technical analysis system around it or anything like that. The reality is that you're just essentially going in and hoping to ride this thing for the long term. But if you are unlucky and you enter here, then you have to be willing to ride through this. If you enter here, you have to be willing to ride through that, right? Especially since you've got a backtest sample period that includes all of this stuff. So you know that this has happened in the past. So you have to be expecting the fact that if you enter now, you could easily get something that's as big, and who's to say that it couldn't be bigger? Okay. But my point here is that you just have to, when you do invest in a portfolio, you can't just expect that you're not going to get a drawdown. And the flip side of that is some people say, well, look, the market's done this for the past 10 years. I'm just not going to enter until we get the next 50% drawdown. But the problem with that is, who's to say that this thing can't run for another 10 years? It could happen. And then you're going to essentially be missing out on all this potential money. So that's a huge opportunity cost that you've missed. So the ideal is to essentially get in through to portfolios that don't have huge spikes like this, something that's much more slow and steady kind of thing, right? And the ability to then say, because of that, you're much more confident in looking at this backtest period and saying, I'm just going to jump in because, you know, I know that these drawdowns here are quite reasonable and I can live with it. Let's just say that this is a 10% drawdown on average. Okay, so even if you do get another drawdown period, your expectation is that it's going to be of similar size to the many drawdowns that you've seen in the past, and it's a drawdown that you can live with. And this is just one portfolio, right? Ideally, you've got multiple portfolios working for you. So, next one over here, this is a big one too, and this is the concept of something called survivorship bias. And that signal provider that I reviewed at the start, their top performing, I think, 3 portfolios all have this in common. And so it's really quite an important thing to understand. So let me just quickly explain this visually by scribbling on the screen. So we have the Dow. The Dow is essentially 30 stocks. And they're essentially large cap type of stocks. They're share or price weighted, but that kind of put that to one side. Just think of them just essentially as 30 large companies that are tracked in the Dow, which is basically an index. Now, what happens is that you've got these 30 stocks in there. So what some of these algo providers do is they come up with some kind of momentum style algorithm. And what this does is that it says, all right, well, let's look at these 30 stocks and let's pick the top 4. Okay, so what happens is that they say, all right, over what look back, and they may do something simple such as looking at the past 6-month performance and look at something very simple like a rate of change, right? So if it went up over the past 6 months by 5%, then that's fine. If another stock went up by 15% over the same 6-month period, then that did better. So they're going to choose that one. All right. So they simply compare a 6-month rate of change, and just pick, rank that from best to worst, and pick the top 4, and just simply do that on the monthly basis. Okay. Now there are obviously more advanced ways of doing this. Using multiple look back periods, using different weightings, using dual momentum, and a whole variety of things that you could do. But for now, let's just kind of stick with something very, very simple like this, and so that we can understand the concept of survivorship bias. So momentum look back over the past 6 months, rank them from best to worst, pick the top 4, and off you go. And on a monthly basis, you just redo that. And you may be cycling in and out of the best performing stocks, but the hope is that something that's done well over the past 6 months will hopefully continue to do well over the next at least 1 month, is all you care about, really. Okay, and there are a whole number of financial papers and so on that you can read that the momentum effect is quite strong. Even something like a 12-month look back tends to do quite well, but some people kind of drop it down through to something a little bit shorter. So a 6-month look back is really quite common with a lot of algos that are out there right now, and they do nothing more than simply pick the best performing stocks from an index like such as the Dow. They'll sometimes use other ones as well, but let's just choose the Dow for now, and off they go. And that is the algo, and therefore they provide you those signals. And you look at the performance graph of that, and it looks beautiful. So what is the issue? What is wrong about this? Well, there's nothing wrong with this concept whatsoever about what you're doing, about the fact that you're essentially momentum investing across large cap stocks. Perfectly fine to do that. But what's not fine is this equity line. This equity line can be massively misleading. Why? Well, the reason for this is because what happens is that if you look at how many of these algos work in terms of providing or creating this particular backtest, is that they say, all right, so we're currently in July, so they would have looked at June last month, all right, the change from June to July. Well, let's just say July, which let's pretend that this algo works on the first of that particular month. So in July, they would have looked at this, picked the top 4 stocks, and you'd be invested in that right now. Then in June, on June 1, they would have done the same thing. You've got the 30 stocks. They would have picked the best 4 top performing stocks. They may have been something different. Okay, let's say it's these ones down here, and you would have been invested in those. In prior months, same thing. Top 4, top 4, top 4. You may look at this and say, that's fine. That's completely logical. But what's going on is that what they're doing is that they're looking at these 30 stocks and they're making the assumption that the 30 stocks are always in the backtest. So in other words, they're using a static list, today's static list, of what the Dow is, and they go back in time and simply pick the best 4 performing stocks from this static list of 30 Dow stocks. That is a huge problem. And the reason for that is because this list is not static. If you go back through to, let's say, some prior point in time over here, what you'll find is that if there was a bad performing stock, it gets thrown out of the Dow and it gets replaced with something else that's performing well. Okay, so the Dow itself, just as a matter of fact, like many of the indexes like the S&P and the RUT and so on, they kind of already are a momentum algo, if you think about it, because the stuff that's performing badly gets thrown out and it gets replaced with stuff that's doing well. Okay, so it's kind of already a momentum algo. So what they're doing is that they're making the assumption here that this list is static, and it's not. It changes from time to time. So let me kind of demonstrate that. So here's an example. So this is, as of March 2019, this was the static list of the Dow stocks. But if you look through this, you can see that GE is not there. Why is that? Well, that's because back in June 2018, GE got dropped from the average. They got replaced by Walgreens. You might say, why? Well, that's why. Right? They were doing pretty well, even though they've got an earnings kind of issue here. But look at this. All right, they went from $30 down to $12. All right, so they got thrown out of the Dow and replaced by something else. So why is this a big deal with the concept of survivorship bias? Well, if you go back through to here, if this is the static list that the algo is looking at, and they're using this for the entire backtest back in time, you can see that GE is not there, like we said, because it got thrown out. Well, that means that the algo that you're now backtesting never gets the opportunity to make a bad decision. It never gets the opportunity to invest in GE because it's not on the static list. Okay? And therefore, had you done that, this may have been where this thing over here dropped by 50% or more. But the algo never gets a chance to make that mistake because GE is never listed in there because it's not in today's current list. So you see, the fact that they're using today's current list, by definition, is going to give them pretty good performance results because the fact that they're in today implies that as of today, they're the strongest stocks around, or some of the strongest stocks around. Okay, so the performance graphs are always typically going to look nice because of that. So survivorship bias is a huge issue, and just be very careful with that when you're looking at algos that essentially do that they pick the top X performing stocks from some kind of index. That should be the first question that you ask the signal provider. Do you guys take into account survivorship bias? Right? And by the way, I did ask this signal provider that as well as many other questions, and they replied through to most of my other questions, but they never replied through the survivorship bias question at all. No surprise there. Okay, that is a big issue. Sorry, questions come up. So what if GE is not in the past Dow? You're testing Dow, not GE. You're investigating best 30 stocks, not in GE. No. So basically what I'm saying is that if you're using this static list, which is what they're doing, your algo never gets a chance to invest in something that got dropped in prior versions of the Dow. Okay? Again, I'm not saying that the concept is bad. What I'm saying is that doing it this way, using a static list as of today, is bad. So how do you do it properly would be the next best question people will ask, right? And there's perfectly valid ways to do this. Obviously, if you're writing your own code, you can do that. But if you guys want to buy an existing platform that can do that, if you look at something like Amy Broker, right? Which is essentially an algo kind of backtester, but it's really quite user friendly. And you tie that with NOR-get data here. This combination here enables you to do this properly. So in other words, what's going to happen is that when Amy Broker is, in 2005, May as an example, then in this particular period, it's going, when it gets its data from NOR-get data, it's basically saying, show me the 30 stocks that are in the Dow, but as of 2005 May. And from that, it then goes in and chooses from these 30 the top 4 stocks as an example. Okay, so the concept is perfectly valid of choosing just the best momentum stocks within an index, but just make sure that the algo provider or signal provider over here is not using or falling for the concept of survivorship bias. That can massively change the results, and I've seen this kind of, if you just do it before and an after, and the results are amazing. You get something that goes from beautiful to something that looks horrendous. All right, so hopefully that's clear. All right, that's just me. This is if you want the link to where to get the historical list of Dow and see it change, then you can use that link there in Wikipedia. All right, next one over here is the concept of security replacements. So what happens is that if you run a backtest and you run a backtest, let's just say with SPY, this particular ETF started from a particular date. I think it started 2004, I think, thereabouts. So you might say, well, clearly, I would prefer to kind of go back further in time and not just start from whatever date that particular ETF started. So what security replacement will do is that you essentially find something that's equivalent through to whatever it is that you're trying to track here, and you replace it with something else, such as VFinks as an example. And this is just a Vanguard fund that essentially still tracks the same kind of stuff. So these things are equivalent, and if you essentially run a back test of the performance of this versus the performance of that starting from the date that they were both available, you want to see that both lines essentially track super close to each other. Okay, so saying that you can then kind of replace something that goes back further in time. This over here might start from 1987 or something, and now by using a Vanguard fund equivalent as an example, as a security replacement for an ETF that you actually actively trade in, you can now get a much larger kind of look back period, which is what you want. So I will personally typically run portfolio kind of backtest with Vanguard funds because of this, so I can go back as far as possible. But then when I live trade, I won't necessarily trade with this stuff at all. I'll likely switch over through to some kind of ETF that's highly liquid and trade that in its place. Okay, but I'm trading on a portfolio that I've now been able to backtest much longer than what the actual ETF was available for. So nothing wrong with doing this kind of concept of security replacement, but what's important is that the person that you're actually using ideally discloses what those security replacements are. Okay, and this is a site here that I'll be giving you a very quick demo of at the end of the presentation, called PortfolioVisualizer, which is fantastic and free. And there, if you go into their FAQ section, they will then you then look up data sources for asset class returns, and you can then see exactly that. So you can see here for large cap blend that they're using VFinks to go back through to 1977. Before that, they're using this Kenneth French research data to go back through to 1972. Okay, so you can see all that kind of stuff. So as long as they display this, that's good. And the reason that I say that is because sometimes maybe a security replacement is not the best thing. So if you kind of track it side by side, just to kind of give an example, maybe it tracks like this, and you say, hey, this is just too much of a gap. It's not a good security replacement, right? So in order to validate that what they're doing is correct, you want to make sure that you can, again, during the period that they're both available for, you want to track them side by side and make sure that they're almost pretty much on top of each other. That will tell you that the security replacement is valid. or as close as you can get to valid, right? So that security replacement, nothing wrong with doing that, but again, ideally you want to know what those security replacements are and the year periods kind of thing, so that you can then validate that it's accurate for your own testing. Now, something sort of similar to that is the concept of synthetic instruments. And you see this a lot with volatility products. So what happens is that these volatility products are super complicated in terms of how they're all calculated, let's just say from a math perspective, right? In terms of what they look at, and it's the derivatives of derivatives of derivatives and all that kind of stuff. The thing is, they start from a particular year. So let's just do the same example as before. Let's pretend that a particular ETF that you track starts from 2004, and from here onwards, you've got that data, but you say, well, I wonder what would have happened if I wanted to go back further in time. So if you want access through this, but the ETF didn't exist prior to this, in this instance, there may be no security replacement because the concept itself was born here, right? There's nothing to replace it with that tracks the same thing. So it's a kind of like a new concept, right? So if that is the case, what some people then do is they say, well, we understand the math involved in calculating this particular derivative. So all we're going to do is that we are essentially going to replicate this math, create our own synthetic version of whatever that ETF is, and we are going to go back a huge portion of time and go back an additional 50 years. Okay? This stuff over here, I don't like at all. And that is because this thing here is complete fabrication. They're assuming that the math involved is going to essentially act in the same way over here than real life trading does with this particular instrument over here. All right, I do not like synthetic instruments at all. I just don't trust the results. Because again, this was not live traded at all during this particular period. Okay, so if they use synthetic equivalents, personally, I stay away from it. It's up to you if you want to, dip your toe in the water. If anything, I'd at least be skeptical of the results that you see during that particular backtest period. All right, here's a big one, not accounting for trading costs. Right, there are huge amount of providers out there that show you these beautiful results with all their algos and so on. You then read the fine print, and the fine print typically says something like, well, since every broker charges different types of commissions, and we don't know if your personal situation and what rate you can negotiate, we leave the concept of adding costs up to each individual investor, right? Something along those lines. So they just completely wash their hands of trading costs and say, that's on you, that's not on us, and that's in their fine print. That can be a big problem too. So ideally, and the reason that I say it's a big problem is because I've again seen examples where you've got portfolios that look really nice, bottom left to top right, you suddenly add trading costs and it turns it into something like this or something like that. And just the concept of adding trading costs alone can potentially destroy a trading strategy. Okay, and that's something you need to be aware of. And this is part of the reason that things like, for example, rebalancing periods and so on. I know I've not explained that, but let's just say that if you've got a portfolio that you're looking for long-term investing, let's just say it's 50% in ETF 1 here and 50% in ETF 2. No, sorry, this is not part of my slide content. I would have added that, but let's just quickly touch on it. So what can happen is that, let's say that this ETF here goes to the moon, right? You bought it at 100 and now it's worth $300 per share. Okay, so what's going to happen in a nutshell is that your portfolio, which was invested 50-50 at this point in time, is now massively overweighted through to ETF 1. So now what's going to happen is that any kind of volatility type of situation that happens to ETF 1 is going to have a massive impact on your portfolio because of the fact that it went from 100 to 300. Okay, and stuff that happens through to this little guy over here, ETF 2, will barely be felt, good or bad. All right, so this over here now becomes almost as if you are fully invested in ETF 1 alone. or 95% invested in ETF1 and 5% invested in ETF2. That's not what you want. So what happens is that when you have this kind of situation here, you essentially rebalance your portfolio. So in other words, you sell off some of ETF1, which has appreciated so much in value, such that you then rebalance it back through to the allocations that you originally wanted. Okay, so that's the concept of rebalancing. So what will happen with some strategies is that you'll see that some algos are now rebalancing weekly, and some rebalance daily when you look at that. The problem is that the second that you're now rebalancing daily, and you're paying $5 a trade, as an example, for each, sell and then buy, that absolutely kills your performance here, just due to commissions and commissions alone, and slippage, of course. Okay, so when you've got algos that are rebalancing very, very frequently, be careful with that, because commissions can absolutely eat you up, and that's especially the case with providers that are not including trading costs into their results. Okay, the ideal is that they do include trading costs and reasonable trading costs into their results, so that way the equity lines are much more realistic. Okay, and I think this is the last topic in terms of the problems, right, to watch out for, and that's the concept of data mining. And data mining is actually a huge problem. And without you kind of reading through the text that I've got here on the screen, let me just give you one little analogy, I guess, right, that hopefully will click, and that is, let's pretend that I go off and, let me scribble on the screen here. Oops. All right. So let's pretend that I am in a room here, and in this particular room, this is me, and I've got a friend here, and this friend has some kind of camera device. I can't draw, by the way, so pretend that's a camera, video camera of some kind. And he's now going to film me run an experiment. So what I've got is I have a standard coin here. It's not weighted. It's just a standard coin. All right. It's heads on one side, tails on the other. And I flip that particular coin, and I basically get a head. And this is all being filmed on camera live, by the way, right? And then I flip it again, and I get a head. And I flip it again, I get a head. And let's pretend that my objective here is to, back in Australia, there's actually a game called 2 Up. I don't know if that exists over here, but it's essentially, it literally is a coin flipping game, right? That they kind of play at some casinos. Nothing kind of fancy. So let's pretend that I'm essentially paid whenever I get a head, right? So I keep flipping. I keep getting heads. Is this possible? Absolutely. Is it likely? No. But it's possible. This can absolutely happen. Okay? So I've done this, and I've done this live while some dude has filmed me live doing this exact thing. So then I go and I basically market this, and I go up through to, Joe Blogs on the street. I say, hey, I have literally filmed live the fact that I have this magical coin that when you flip it, it gives you nothing but heads. Now, Joe spends $1,000 buying this magical coin from me. Then he goes to the casino or whatever, and then basically starts flipping, and now the guy starts getting tails. Or some kind of, hybrid there. Nothing that looks like this. Now, does that mean that this person here cheated? No. They were on film, live, showing that they did exactly this. But what's happened is that what got filmed was an unlikely event. And now the person that bought that system sees what is actually a very, very unlikely event in a massive randomness, but it's just one data mined result here that was beautiful. And if we translate this into essentially being paid on a heads, what would this look like if you look at an equity graph? Beautiful kind of line that looks like this. Okay? This is the concept of data mining. Doesn't mean that the person here is cheating. They were filmed live doing this. But this person over here was essentially duped in this particular case, because they think they're buying this, but they're getting this. All right. Now, these days, you would have heard of things such as artificial intelligence and various other kind of machine learning and supervised learning and all these kind of new whiz-bang things. These things are fantastic at finding this. Okay? You give them essentially randomness, they find that needle in a haystack that is all heads in a row. And then you see this beautiful equity line. So then what do? You go, oh my gosh, my machine learning system just found the holy grail. This is you now. Investing in this, and then this becomes your equity line when you trade it live. All right? That, in a nutshell, is data mining. Really tough problem. Not everybody that does this is trying to dupe you. There are a lot of people, by the way. You can actually go online and a whole bunch of people selling all of this fancy machine learning software that they claim they will find this for you. And they will. The software will absolutely do that. But that's not tradable. Okay? If you're going to trade something like that, you have to have a massively advanced system in order to do really advanced robustness training, in order to try and validate whereas this thing is actually needle in a haystack or if it's something that's tradable. Most of the time it's not tradable. I'd say 95% of the time, if not more, this is crap. Okay, it will not give you any performance in live trading results. So again, it's not just people trying to dupe you, even though there are, but people, you can fall for this yourself, right? When you're running data mining kind of rigs, with machine learning, whatever that might be, it's a lot trickier than what people think, right? So that tossing the coin thing was one analogy. This is just another analogy, right? I was trying to come up with something visual, but you've got a maze. If you have a computer program that can essentially randomly just go through everything, eventually it's going to find its way through, right? But then this red line is not guaranteed money, because the second that you now introduce new data to it, which, new data is essentially live data that you'd be trading in the markets, if it looks different, then that thing will fall flat on its face. All right, so that was the concept of data mining. Actually, the last one here is the concept of an out-of-sample test period. So let me give you an example there. Let's say that you go to Amazon and you buy yourself a book, and the author there is talking about some kind of algo that they think is the best thing since sliced bread. So what you do then is that you go and you say, all right, let's have a look at when this book was published. And you find that this thing was published in 2003, as an example. And you look at the backtest that the author had put into the book, and you see the beautiful kind of equity line like that, right? So one of the easy things to do is you say, all right, well, fine. The book was published in 2003. This is what the equity line looked like in the book. So therefore, this point here is 2003. So on the assumption that the book tells you how to trade this algorithmically, you should now be able to replicate that algo. And now, since you know that the book was published here, and we're now in 2019, all of this period from here to here is essentially now out of sample. Okay, so what I mean by that is that if you now run the same algo from 2003 forwards, and the thing ideally, if it looks like that, so in other words, if it looks very, very similar to what it did during the in-sample period, that's fantastic. That means that that strategy is still very, very, very viable. Okay. In all likelihood, you're not going to get that though. In all likelihood, you're going to get something that is probably going to look more something like that. All right. And in many other instances, you're going to see this. And this is going to be the result of a whole variety of things. But, one of the things can be the fact that this here was susceptible through to data mining, number one. Another thing that can happen is that when the book was published, this over here, which represented some kind of edge in the market, when it became well known, everybody traded it, and the edge basically disappears quickly. Okay, that's quite common, you'll find, right? But the concept of this out of sample thing is what I really just want you to understand, right? The in sample versus out of sample. If you test during an out of sample period and you get decent performance, or ideally performance that matches what you see in the equity line that came before it, then awesome. If not, then it could be due to a variety of reasons. and it's a very common thing to see it not work, okay, during an out of sample period. All right, and I keep saying last thing. I think this is the last thing. So here, again, it's just a matter of trying to internalize when you see the performance results. You ideally want to get access through to these types of stats, which may not be provided by the signal provider, right? Because again, the equity line may look beautiful like this, but this kind of equity line may require that the algo goes through 10 losers in a row, right? And if you're now going to start panicking after 3 losers in a row, then that's not good, because you're not going to have the guts to stay in, to stay for the long game here and get this equity kind of return that you're looking for, because you simply can't stomach this. But if you don't even know the stats, then how can you even get into the algo in the first place? You need to know what these stats are, right? Max consecutive losers. What's the largest loss, right? Intraday loss, by the way. Not just equity peak like we talked about before, okay? How much time is spent in drawdown? You might, if you look at something that, for those of you that understand the concept of Sharpe ratios and all that kind of stuff, a lot of people say anything with a Sharpe ratio over 1 is fantastic, okay? But do you know that something that has a Sharpe ratio over 1, you could be in a drawdown for 2 years, and that's a completely viable Sharpe 1 portfolio? It's just that you got one of the unlucky lines that you're actually tracking. But this is still a Sharpe 1 ratio, okay? Other people that are trading another Sharpe 1 ratio may have actually gotten fantastic performance during the same period that you were underwater for 2 years. They've got Sharpe 1 and you've got Sharpe 1, right? So, all of these things are fairly important to understand, so that you can internalize and make a valid decision whether you can trade that particular portfolio or not, in terms of whether it's a match to your trading personality and risk tolerance. But if you don't even know what those stats are, how can you make an informed decision? Okay, all right, so let's take a quick look at this tool that is awesome, and it is called PortfolioVisualizer. Again, completely free. So I will give you 3 little examples that I've got here, just to give you a taste. All right, so one of the things I'm going to do here is I'm going to go through to backtest asset allocation. And what you can do is you can basically go in here and choose the different types of asset class you want, and then choose a weighting, and you can have up to 3 separate portfolios for that. Now, I'm not going to do that. I'm going to cheat, and I am going to give you access through to, or they give you access through to what they call lazy portfolios. So you can see that there's a whole bunch of pre-built portfolios for you over here that you can choose from. And one of my favorites is this one, the Ray Dalio All Weather. So you can see it's 30% in the US stock market, 40% in long-term treasuries, 15% intermediate-term treasuries, 7.5% in commodities, 7.5% in gold. All right. If you look at this is simply going back as far as it can, starting off at $10,000, rebalancing annually, right? So quite relaxed. And actually, I'm going to use a benchmark of just the market. Just think of this as SPX. And that's it. I'm going to click on Analyze. And here's the results. Now, the result is limited to a degree right here, because in this particular case, it's going back through to 2007. Ideally, we want to see something before so that we can see the .com bubble crash in 2000. Right? And what's going on here is that if you read this is basically telling you that it's due to the fact that you've got commodities in there with this particular asset class, that this asset class is starting from 2007, so that's why they can only go back this far. Okay, so there are ways to get around that, but I can't get into that right now. So the pure thing that I really kind of want to explain there is just look at the smoothness of those 2 lines, right? Compared to one another. If you're more of a numbers person, you can just look at it through here. So you can see here that the market again came down by 51%. This portfolio came down by 14.75. If you recall, this was the same one that I showed in the slides. Okay, reasonable compound annual growth rate, very, very reasonable max drawdown, something you can just put on and kind of almost forget about and not really be overly worried, right? You can see, nice Sharpe, nice Sortinos, relatively speaking. Okay, and you get a whole bunch of stats. Now, in terms of getting access to a lot of the stats, lots of those stats are going to be explained under metrics. So you can see here everything from the alpha, R-squared, Sortino, sharps, Kalmars, tracking errors, kurtosis, skew, whole bunch of stuff, right? Part of the problem, though, is that most people don't really understand what those things mean, and or have a very, very superficial understanding of what it means. So that is one of the issues, I guess, with this particular site, because it assumes you know all this stuff, right? You understand what all these stats mean, and you can use it simply as a tool. There's no training kind of involved. But very, very easy to go in and just experiment with different asset classes and just see if you can put something together that looks nice. Again, Ray Dalio, by the way, those of you that don't know him, he's a billionaire that runs the largest hedge fund in the world, right? So not a bad kind of place to start. And again, I actually live trade a version of this. I've added some tweaks to the Ray Dalio, but I think it's a very, very solid kind of place to start for a long-term portfolio there. So that's example 1. Example 2, we're going to look at down here, something called rolling optimization. And what this thing here is going to do, so what we're going to do, so I could basically use something like SPY here and something like TLT for bonds, right? But to give you an example of that, I'm going to replace this with the Vanguard equivalent so that we can go back further in time. So for here, I'm going to use VTSMX, which is a total stock market. So think of this as a blend between, let's say, SPY and IWM is kind of a simple way of thinking about that. And then this one here is VTITX, which is intermediate term treasuries. So this would be, if you trade ETFs these days, this would be the equivalent of IEF, okay? And here I'm just going to do a basic allocation. Most people have heard of the 60-40 split between stocks and bonds. Right, but what we're going to do, which is one of the really nice things about this software, is that you can choose more advanced ways of allocating to your portfolio. So instead of doing a static allocation here of 60-40, what I'm going to do is I'm going to do something called risk parity. So very, very quickly, risk parity is, every single thing that you trade is going to have a volatility. Okay, so what risk parity is aiming to do is to basically say, well, let's make the volatilities of the things that we want to trade equivalent. So they provide an equivalent amount of risk to our portfolio when traded as a whole. Okay, so if something had a volatility of 10 and you want to reduce it to a volatility of 5 because the other thing is also at a volatility of 5, then you can just change your allocation so that the volatilities are both 5 on each. All right, and you're going to be doing that in this case on a monthly basis. And I'm going to look at a look back of the past year. So of the past year, on a monthly basis, I'm going to reweight the portfolio such that the volatility of these two things is equivalent. All right, and I'm also going to do, as a second kind of allocation, just a static allocation here of 60-40, and I'm going to compare that to a benchmark of just the market. All right, optimize. And you can see how quick this thing is, by the way, right? So here are the results. So the results here, you can see the yellow line, which is now being highlighted, which is the kind of the most wild one that you see up on top. That is the standard market. Then you can see the blue line here is the provided portfolio. The provided portfolio is the one that's using static allocations. And the red line, what I want you to visualize, look at how smooth that red line is in comparison. Now you might say, well, but it's not performed as well. That's correct, but there are ways of getting around that, right? You can use leverage and various other things in order to beef up those returns, but notice how effectively the volatility has been smoothed out just by using risk parity across those two things, across two different uncorrelated assets, essentially in this case. All right, very smooth, slow and steady kind of line, something that's not going to make you lose sleep whatsoever. And you can see here, going back through to 1994, so that's a pretty decent look-back period, including major crashes. You've got, for a long-term portfolio, a respectable kind of return there, but with very nice risk-adjusted returns, as you can see here. And you can just visually see it, right? It's very, very flat line, nothing wild, and looks decent. All right, so that is risk parity. And the last one I'm going to show here is something called dual momentum. And you'll hear about a book called Dual Momentum by a guy called Gary Antonacci. And he talks about a very simple system that he invests in VFINX, which is essentially a Vanguard fund for the large cap market, and then VGTSX, which is an international equities, which excludes the US market. And then we're going to select this guy here. I'll explain this in a sec. VBMFX. This is essentially, you can see here, it's total bond market. So this is investing in bonds of different maturities. Okay, so now what is dual momentum? Well, dual momentum, explained very, very quickly here, is going to look at the performance of the tickers that you've specified here, and then it's going to do something called a relative momentum calculation, which simply means find the best performer over your particular look back period. And here, let's just use a look back of 6 months. All right. So over the past 6 months, it's going to essentially find the best performer between the US market versus the international non-US market. And it's going to choose the best out of these two. So it's only going to be invested in one. And so that's the concept of relative momentum. And the concept of absolute momentum, which he talks about, is that if both of these are actually trending down on a momentum basis, then why would we bother investing in something that's going down? Right? So in that case, if both of these tickers here have negative relative momentum, then it's going to put the money in through to this thing here. And this is just essentially a blended bond investment, okay, across different maturities. So that's all it is. Pretty simple. Run test. Actually, I'll put in the benchmark of the market as well. And that should look interesting to you too. Okay, so the red line down here, that's a stock market. That's SPX, that's SPY. The blue line is a simple portfolio. Okay, you might say, okay, it outperformed, but what are the risk-adjusted metrics? Well, the market drew down by 51%. This other thing drew down by 17.8% and it includes multiple periods of crashes. Okay, notice that this goes all the way back to 1997. Max drawdown of, let's call it 18%. Here, and it outperformed the market. Right? And on a risk-adjusted basis, you can see it's significantly higher, almost double, using something very, very simple. All right, so that is the third example. There is a ton of stuff here with what this site can do. It's a fantastic site. But again, the problem is that a lot of the stuff that it talks about, in terms of different types of structures that you can optimize to, or the stats, or the metrics that they actually report, are you won't understand. So what I have done here is put together a course called Long-Term Investing, and it's fully going to explain all of the stuff that you actually need from zero. It assumes no financial knowledge of any kind. It explains everything, all of the concepts of your volatility and so forth, how to interpret different portfolios, how to compare portfolios together. And by the way, let me just quickly show you. I know we're almost out of time, but let me quickly show you this.
The real question
I recommend that you watch this video here yourself, but let me just show you this. This is Ray Dalio speaking, and this is him talking about what he considers to be the holy grail of investing. And it's essentially represented in this chart here. So very quickly, what this is the number of alphas in the portfolios. In other words, how many concurrent portfolios are you running? Going from left to right, it's increasing the number of portfolios. And the y-axis here is the standard deviation, the overall annual standard deviation for all of the portfolios combined. So in a nutshell, what this graph is trying to get to is that if the portfolios that you are trading together are uncorrelated, so you can see here with the different lines. So the green means 0% correlation. This is blue is 40% correlation, and so on. If you're putting stuff together that is uncorrelated to each other and trading it together, you can see that by having even just a couple, let's just say 4 different types of portfolios that you are trading, but they're uncorrelated to each other, then you can get a massive reduction in volatility of your overall portfolio. And remember what we talked about in the original slides, where volatility is always going to hurt your compounded returns. Okay, so the objective is to try to lower your overall portfolio volatility, and you can do that by trading stuff that is uncorrelated to one another. Right, and he believes in it so much he calls it the Holy Grail. So I recommend watching that video. It's only like 5 minutes or something, really short. Oh, by the way, to get to that page, it's tradingdominion.com/LTI for long-term investing. All right, but let me kind of flip back to it, show you that. And there's some stuff down here, so you'll get to see all the stuff that that I go through. I explain everything from all the different asset classes, how bonds work, all the different types of returns that you're going to be looking at, all the different ways of measuring risk, correlations, factor models, a bunch of I cover about a dozen different types of portfolios. We cover modern portfolio theory in depth, so you'll understand all about that, how to scale, dual momentum, blah blah blah. And I've put together a bunch of spreadsheets over here that add automation, so you can take results. So say, for example, you are looking at one of these signal providers and they provide the monthly results. Well, you can actually grab those monthly results, put it into these spreadsheets, and then essentially click a button and it does all the analysis for you. Okay, and then you can compare one portfolio to another. You can see what the rolling correlations would be, so on and so on. So a lot of intelligence in those spreadsheets there. And the last thing I'll touch on before we finish up is this the concept of, if you guys do trade options and you're thinking about how could you possibly combine option trading with long-term investing. Well, let's say that you're let me flip back to a slide here. So let's say that you are in a scenario that you've got whatever, 200K account as an example, and then you're using the entire account to do your option trading. Okay, and let's pretend that you're doing some kind of butterfly type structure. So if you are doing something like that, then let's pretend that you're pulling, let's say 20% a year on the entire account. So you're doing quite well, and you might be perfectly happy with that. But one of the cool things about this is that what you'll find is that with a butterfly structure, the butterfly structure is going to have, if it's all inputs, it's essentially, this is going to be a put debit spread here, and then this thing over here is going to be a put credit spread, right? So what happens is that the credit that you have from this thing here is going to more or less pay for a significant portion, if not most of it, of the debit that you've got to pay for the put debit spread portion of the wing, right? The put debit spread portion of the wing essentially is going to reduce your cash outlay from your account, but the put credit spread is a credit, so therefore it brings cash back in. Okay, so these two things over here, they don't fully cancel out. Obviously, you are going to use some cash, but they largely cancel each other out. Okay, if you are doing these types of structures. So therefore, even though you are fully trading your accounts using these types of structures as an example, and I'm not suggesting that you should be trading 100% of your account. A lot of people like to leave a buffer of cash and so on. That's fine. Okay, I'm just saying as an example, just to kind of get to a point. But if you are trading, let's say, the full account, and a large part of your cash outlay is essentially being offset because of the structure that you're trading here, one of the cool things is that you can then essentially put money into long-term investing style portfolios. And let's just say you do the entire thing, and you do, or close to, let's just say you do 180 as an example. But you're of course going to want a conservative portfolio over here, something, and ideally you're going to have a few portfolios working together, so you can get what Ray Dalio calls as the Holy Grail there, right? And reduce your portfolio, your volatility due to having uncorrelated portfolios working together. And you might aim for something like a 10% annual compound annual growth rate, but with something that is going to have a max drawdown of 10%. So you're not going to lose sleep over this, right? It's just something that's slow and steady, and by combining these things together, and you're now essentially using the cash that it was previously just sitting there in your account, because you were using you were consuming your option buying power by doing these kind of structures, but you had a huge amount of cash just sitting there. So you can take that cash that's in your account, put it in through to long-term investing things that will now give you a pretty nice return with very small drawdowns, providing you're trading conservatively here. And if you were to have a scenario like this, you could be in a scenario that you could, even 20% returns on your option trading is a really good return, but why not bump that up by another 10%? Okay, and take it from 20 to 30% as an example if you were to do something like this. So that's just an idea, and that is what the people in my community are doing now. Okay, we're basically using the cash in our account for a set of conservative portfolios, and using that to essentially bump up our option trading returns by something decent. All right, so that's pretty much all I had. I know I've gone a little bit over, so apologies for that, but I tried to go through it as quickly as I could.
Yeah, no problem. There was just one more comment. I think that's Bruno. It's a little long, so maybe I'll let you just read it.
Okay.
I think he posted it to panelists and then to panelists and all attendees.
Yeah, it doesn't look like a question to me. It reads as...
It looks more like a statement.
Yeah, so that's fine.
Yeah.
Yeah.
All right, Ron. Well, it looks interesting. I think everybody should be aware of the effects of volatility on portfolios, and I know a lot of people don't really pay attention to that, but it does make a big difference. So thanks for
and play with that site, PortfolioVisualizer. It's really, really, really good, and it's free, so no reason not to.
Yeah, can't argue with the price.
Yeah.
So I'll put this link in the recording, and I'm sure the course is excellent. All the stuff you do is. So thanks for giving us a peek into what's the details of the course and a little bit of education. So thanks, Ron.
All right. No worries. Thanks, Tom.
All right. Take care, everyone.
All right, see ya.